You're about to sign the biggest check of your life, and the number on the paper isn't actually the number. There are costs hiding inside a home purchase that nobody sits you down and explains. Not your agent, not your lender, not your parents. By the time most people find out, they've already signed. If you're new here, I'm Stickman Dad. I go over the stuff someone probably should have sat you down and explained a long time ago, but never did. If that sounds like your kind of thing, go ahead and hit subscribe now. There's a lot more of this coming. Today we'll be covering a complete breakdown of the hidden costs of buying a home, not to scare you out of buying, but because a few of these can genuinely blindside you if you don't see them coming. I'm saving the biggest one for the end because it's the one thing that changes how you think about everything else on this list. Let's start with the one that hits people in year one, completely out of nowhere. Your property tax bill is almost certainly going to jump the moment you buy. Here's why. If the seller owned that house for 20 years, their tax bill was likely locked in or capped based on what the home was worth a long time ago, often far below what it's actually worth today. When a property changes hands, the assessor typically resets the assessed value to your purchase price, since that's the best available indicator of current market value. So the seller's old tax bill, the one your agent probably showed you, has almost nothing to do with what you'll actually pay. The fix is simple. Ask your agent to calculate taxes based on your purchase price, not the seller's. One phone call can save you from a very unpleasant surprise. Next, something that's been getting worse and a lot of buyers find out the hard way, sometimes right before closing. Homeowners insurance used to be a formality, not anymore. Premiums jumped nearly 30% from 2024 to 2025 nationally. And in high-risk states like Colorado, Louisiana, California, and Florida, several insurers have limited coverage, stopped writing new policies, or gone insolvent entirely. Here's the part that can actually kill a purchase. As insurance gets more expensive and harder to find, more buyers simply can't close since lenders require coverage. A recent survey found nearly half of buyers and sellers ran into insurance issues during a transaction, and 21% said the deal fell through entirely because of it. 1 in 5. So before you fall in love with a house, especially somewhere coastal or wildfire prone, get an insurance quote before you make an offer, not after. Now, for the stuff that's genuinely hard to see coming, even if you're paying close attention, if you're buying into an HOA, you already expect monthly dues. What most people don't expect is two other costs layered on top. The first is a capital contribution, or HOA buy-in fee, a one-time payment at closing, separate from your down payment and closing costs just to join the association. It can run from a few hundred to several $1,000s, and it's usually buried in the HOA documents, not the listing. The second is a special assessment, and this one can hit you even after years of a perfect payment history. HOAs are supposed to maintain a reserve fund for big repairs, roofs, elevators, parking lots. If the board hasn't funded that properly and something expensive breaks, they can bill every homeowner to cover the gap, often without a vote. Before buying into an HOA, request the reserve fund study and recent financial statements. An underfunded reserve means you're not just buying a home, you're buying into someone else's deferred maintenance. Two more can surprise you right at closing. The first is the appraisal gap. In a competitive market, if you offer above asking, the bank still sends an appraiser to confirm the home's worth what you're paying. If that number comes back lower, the bank only lends against the lower figure, and the gap has to come from somewhere. You either bring extra cash, renegotiate, or walk away. And if you walk, depending on your contract, you could lose your earnest money deposit, often 1 to 3% of the purchase price. In a bidding war, some buyers waive the appraisal contingency to look more competitive. That's a real risk worth understanding before you take it. The second is title insurance. It's easy to gloss over in a stack of closing costs, but it's protecting you against ownership problems, unpaid liens, disputes, errors in public records that can surface years after you've moved in. It's required if you have a mortgage, but the owner's policy, the one that actually protects you and not just the lender, is worth paying for too. Of everything on this list, it's the one cost that's genuinely working in your favor. One more that trips up people who thought a fixed rate meant a fixed payment. You lock in your rate, your payment is set, you feel good, and then in year 2, your monthly payment goes up anyway. Escrow is the reason. Most mortgage payments bundle in property taxes and insurance collected monthly and held in escrow. Your lender estimates those amounts at closing, but if your taxes rise, which as we covered they often do after a sale, or your insurance premium jumps, the account comes up short. The lender does an annual review, finds the gap, and adjusts your payment to cover it. Your rate didn't change, your principal didn't change, but your payment did. Watch for your annual escrow analysis statement. If there's a shortage, you can sometimes pay it as a lump sum instead of spreading it across the year. There's also PMI, private mortgage insurance, required if you put down less than 20%. Here's the part that stings. PMI protects the bank, not you. It typically runs 0.5 to 1% of the loan per year. On a $400,000 loan, that's $2,000 to $4,000 annually added right onto your payment. And it doesn't always disappear automatically once you hit 20% equity. You can request cancellation at that point, but lenders aren't required to drop it automatically until you hit 22% based on the original purchase price. If your home's appreciated faster than that, you may need a new appraisal and a formal request to actually get it removed. Last one before the big finish, seller concessions. You've probably seen listings where the seller offers to cover closing costs, and it sounds like a deal. Sometimes it is, but sometimes the purchase price just gets bumped up to cover it. So the seller isn't really paying anything, and you end up financing those closing costs over 30 years with interest instead. Not always a bad move, but you should know what's actually happening before deciding if the math works for you. All right. The one I said almost nobody explains before you sign. It's how your mortgage actually works in the first decade or so. And I want to be specific because the specifics are what make this real. Early in your loan, your balance is still high, so most of your payment goes toward interest, and only a small remainder chips away at principal. Here's what that looks like in practice. After 5 years of mortgage payments, you'll have paid roughly $145,000 to your lender, but reduced your remaining balance by only about $27,000. 5 years of payments and roughly $118,000 of it went to interest. In fact, more interest gets paid than principal for about 60% of a standard 30-year loan. That's 18 years where the majority of every payment you make is going to the bank, not your equity. This is why selling in year 3 or 4 often means you've built almost nothing despite paying on time, every time. It's also why even one extra principal payment a month can shave years off the loan and save tens of thousands in interest, since it reduces the balance interest gets calculated on going forward. Nobody draws you this picture before you sign. Now you know what to look for. So here's where we landed. Property taxes jump because your assessment resets to your purchase price. Insurance is more expensive and harder to find and can sink a sale entirely. HOAs come with hidden buy-in fees and the risk of surprise assessments. The appraisal gap can cost you your earnest money in a bidding war. Title insurance is the one cost actually working in your favor. Escrow shortages can raise a fixed payment in year 2. PMI doesn't disappear on its own. Seller concessions aren't always the discount they look like. And for the first chunk of your loan, most of what you pay is going to the bank, not your equity. You came into this thinking you understood the cost of buying a home. Now you're leaving knowing what's actually in the fine print. If this helped, drop a comment with the one thing that surprised you most. I read everyone, and it genuinely helps more people find this video. And if you've got a friend heading into their first home purchase, do them a favor and send them this before they're standing at the closing table wishing someone had told them sooner.